This week, part 2, final part, how to invest using rubber bands, our discussion of standard deviation, volatility, and how to think through your portfolio. So last week, we kind of teed up, what is standard deviation? What is volatility? How do you know if it's working? Is it broken? And what are kind of those three main things: expectations, the purpose of an asset class, the environment that you find yourself in as an investor, that really need to be brought to bear to help answer those questions, as opposed to just whether something is up or down in a moment, which triggers that recency bias, which is one of the enemies to any of us as investors. Quick recap: volatility, standard deviation, bringing out our old rubber bands. Just basically, in a normal environment, left to their own devices, what could you expect something to be up or down at a given moment in time? And again, really thinking about that within the construct of just because something is down or up doesn't mean it's good or bad, working, not working necessarily in and of itself. Got to go back, look at those three filters of expectations, purpose, and environment to help answer that question so that you don't give up on something or double down on something at the wrong time. Standard deviation's what we can expect. How do we use this to, again, inform us as investors and how to make decisions? Well, one of the biggest things we need to use standard deviations, and again, this is a little bit what we were talking about last week in terms of expectations, is helping us emotionally prepare. If we go in and we want to be a diversified investor, i.e. we're going to have lots of little rubber bands, knowing they're not all going to do something while this is up, the others may be down, and vice versa. What is our expectation? What is our understanding of those purpose? And one of the big reasons for that is so that we don't get triggered emotionally. As investors, obviously over time, we're hoping we're putting our money into these various things. And even if they are going to act differently, over time we're going to make money. And while we can step back and know that at the time we enter into it, day 2, we're just hoping to see everything up. And day 3 and 4 and every day thereafter, even though in the cool, calm moments, we know that that isn't a realistic expectation. So if we look back and say, okay, look, we know not everything is going to work all the time. That's what being diversified means. When are things getting stretched too much, right? When is something that should be maybe only down this much in a position where it's down even more? If we get that knowledge will inform our perspective. And of course, that perspective then will empower a discipline to stick to a process that more times than not is going to make us act in ways that feel very counterintuitive or against what otherwise would have been our natural biases, usually to buy more when it's high and to give up or panic sell when things are low. Using standard deviation to inform your process. Most of the time, as things are moving up or down across the continuum, sometimes it feels that way, and if they really, as we can see here of late, with stocks going up or down quite a bit, that starts triggering emotions. The more emotional we get as an investor, the more prone we're going to be to a decision that is not in our best interest. The other thing that standard deviation helps, again, is knowing, when are we in one of these environments where things that, again, maybe should normally only be down this much or this much are getting stretched? When we get stretched, our recency bias usually kicks in. We're convinced that if we've gone down this far, we're going to go down even further. Or again, things are up, we're going to go up even further. That's where recency bias starts to play on our fear and greed instincts and get us to act in ways that are not in our best long-term interest. Counterintuitively, again, more times than not, if we know, hey, something usually is only down this much is stretched, we may not automatically want to buy, but it may be a great opportunity to say, because mean reversion, something back up toward this baseline, is how investments, most asset classes will work over time. That's the whole concept of standard deviation and a mean that can inform our decision. It at least lets us know here at 10 Capital, hey, this might be the time to really look harder. Is this a time where the things have gotten too high or, in our opinion, stretched too low? To make some type of a portfolio allocation at that time, use something that's held up to buy something that's down, or again, take off some of the profits up top. The issue with standard deviation, though, is people tend to focus on just the absolute. How low are we, or how high have we gotten, as opposed to how far are we from this black bar median That's the thing we want you focused on, is again, not the feelings that coincide with this or this, but that gap to median. Is this a time where we're too high and we have a danger of mean reversion down, or there's a great opportunity because something's down? It's not a given, it's not an automatic, but actually more times than not, again, can play an important role in informing your next step. An example, much hated asset class that I'm not going to name for you, really a blend of asset classes, rarely down more than 4%. It's only happened 3 or 4 times in history. It's happening as we speak. Every time things have gotten stretched past that normal standard deviation for this asset class, you've seen snapbacks, 2 years of around 30, 3 years of around 40% positive returns, 5 years around plus 80. Is that a given to happen this time? Of course, nothing's a given when it comes to investing, but at a time where a lot of people are looking at headlines or recent performance to inform their opinions and their outlooks, we're looking beyond that to, again, what is history? What is the standard deviation of that asset class? Where are we at currently? To at least, again, help us then dig deeper to see, is this going to be one of those times where the asset class, again, is broken, or where that asset class is providing us and our clients a wonderful opportunity? So again, lots of terms, lots of jargon, standard deviation, volatility being some that we use all the time. Understand how that data, in this case, these rubber bands, what is normal? Not all investments are the same. They're not all expected to do the same things. Getting that knowledge is going to inform your perspective. That perspective is going to inform your process, and it's staying true to that process over time that's going to help you win as an investor more times than not. If you got more questions, if you want to play with this rubber band board that was just dropped off in my office, we're here anytime to be of help. Thanks so much.